Hi everyone, my name's Jacob, and today I'll be presenting to you Fintech. We're first going to start by defining Fintech and going over its history. After that, we're going to go into the rise of Fintech startups, where Fintech companies compete, how Fintech companies differ from traditional firms, and we'll be taking a look at two Fintech companies, Stripe and Chime. After we take a look at them, we will be going over the risks for Fintech firms, the future of Fintech, and we'll be closing out with our discussion questions. So Fintech, or financial technology, refers to any technology that is used to augment, streamline, digitize, or disrupt traditional financial services. This technology can include machine learning, artificial intelligence, robotic process automation, and blockchain. And a few companies that are utilizing this technology to disrupt traditional financial services are mobile paying, such as Venmo, or crowdfunding, such as Kickstarter. The history of Fintech really began in the 1950s when credit cards were first introduced. They disrupted the market by providing consumers another option for purchasing other than cash. And as we look at this timeline, we can see how Fintech technology started out as a hands-on material and is slowly transformed to where we are today, where most Fintech firms operate out of online spaces or mobile phone applications. The rise of Fintech startups started after the 2008 financial crisis. This was mainly due to banks and other members of the financial services industry having a lot of regulations put on them and having a lot of government oversight. This led to them putting more resources towards making sure they're complying with those regulations rather than looking at innovations. And then also, because of the failings of these banks, consumers started to consider different options other than the traditional banks. So innovators looked at the financial services industry and saw the opportunity to translate it to a virtual space. So Fintech startups usually operate in the financial services industry. As you can see, we have business-to-business lending, blockchain and Bitcoin, investing, payments, personal finance, and Wall Street and enterprise. But as you can see, we have two where Fintech companies have recently started to emerge, which would be insurance and real estate. Fintech companies differ from traditional firms, where Fintech firms strive to address a specific gap in the market. In an example of Root Insurance, they use their mobile phone application to record customer driving data and then build a custom quote for that customer by analyzing that data. This is something that traditional insurance companies are not doing, and so they saw the opportunity there and went to address it and give the customer more value. These firms are also very focused on user friendliness and convenience when developing their platform. They want to be able to have a very low level of entry for anyone who wants to come in and use their product. So just about anyone can hop on their mobile phone app or hop on to their website and start using their service. These companies also have more efficient back-end information systems than these traditional firms. That is because traditional firms usually have legacy systems, while these Fintech startups can immediately bring in the best technology to fit for the gap they're trying to address, and it'll give them better efficiencies and better security due to having the newer technology. They also use the virtual platform to give consumers rates traditional firms can't offer. A lot of these Fintech companies offer discounts or less transaction fees and things like that due to them not having brick and mortar stores that they have to invest and pay for. Rather, they're all focused on the virtual space, so they can give those savings directly back to the customer by giving them discounts and things. So the first company we're going to be looking at is Stripe. They are a payment processing firm that was founded in 2010. Their current estimated worth is $35 billion, and their mission is to increase the GDP of the internet. They do this by using their product called Stripe Connect. Stripe Connect is a payment processing interface that allows a smooth transfer of e-commerce from a seller's website to the seller's database and gathering consumer information. So Stripe Connect uses an application programming interface for customer integration. The program handles all payment checks for a successful transaction and also monitors for fraud and not approved transactions. And the application programming interface, Stripe made this so that just about every size business could integrate with this technology. It was built for a customer of any size. So from Amazon to your mom and pop store, their developer team and their came to this product with the mind of, we want this to be able to available for everyone, and that's how they plan to grow that GDP of the internet, is by having such an easily adopted system that any company can use it to make their e-commerce transactions. So in 2018, Stripe Connect was in an economic impact report, Forrester report, where Forrester looked at 4 firms that use Stripe and went over their finances. And after doing that analysis, they found that these 4 companies that adopted Stripe got a 364% return on investment, a 67% reduction in international expansion costs. This is due to Stripe being able to work with over 135 different currencies. So people who adopted Stripe did not have to invest into different systems to handle these new and different types of currencies. Stripe performed all that work for them. And these companies also saw a 25% decrease in chargeback rates. The next company we're going to be looking at is Chime. Chime is an online banking firm, also known as a neobank, that was founded in 2013. By 2018, Chime had over 5 million FDIC insured bank accounts within their system, and their company's mission is to create a new kind of online bank account that helps members get ahead by making managing money easy. Chime would do this by offering no transaction fees, they had no overdraft fees as well, and they also offer their customers the availability to take their paycheck a few days early. And another advantage of Chime is that they will let customers go into their negative $100 into their bank account if they need it. So Chime, primarily while offering making managing money easier, they're also offering a perk to customers who may be living paycheck to paycheck, where traditional banks would be taking money from them consistently with these fees. Chime aimed to resolve that issue. When Chime's marketing team was first trying to gain more customers, Chime applied a predictive personalization AI to optimize their website. This AI would observe human behavior on the site, identify segments, and show the best performing site to each individual. Over this 3-month period, they went through about 216 versions of their homepage. And during the last 4 weeks of testing, there was a 77% increase in new accounts. So the risks for fintech startups are regulatory, DDoS attacks, data breaches, tech failures, and economic recession. The DDoS attacks, data breaches, and tech failures all kind of come together because if one of these things goes wrong, it hurts their whole platform because they're all virtual. There's no place a customer can go into, like say for a bank example, they can't go into one of their banks and withdraw money if the online isn't working. So any of these type of cyber threats are a big risk for these firms. Regulatory risks, in financial services, regulatory changes can occur. And so these firms need to make sure they're aware of it and be able to adapt to it. And then economic recession, for these firms that are just starting out, and have maybe had one or two rounds of investing, they might not have the funds to stay afloat during a recession. Other firms that are larger, such as Chime and Stripe, most likely would be able to survive a recession, but they would be suffering for it as well. So these companies need to be very careful for that, and make sure they're using their money wisely. So the future of fintech firms, what we're seeing is there's a lot more. We're expecting a lot more collaboration between fintech startups and traditional banks. Traditional banks in the past couple of years have started investing in fintech startups. And so the two assumptions there is that either these traditional banks are looking to acquire them down the road and use their technology, or to collaborate or partner with them. We're also going to see increased risk management controls with these firms. With the technological risks and the regulatory risks, these firms need to have a lot in place to be able to adapt to changes, especially security-wise with their virtual platform. They need to make sure that they can respond quickly if there is a threat or a DDoS attack, and be able to resolve it quickly so it does not interrupt a customer using their interface. And lastly, fintech firms will continue to expand their product list. Stripe is already starting to look into small business loans, and then they're also the Chime is also looking to expand their accounts that they have. They started out with just a checking account, but now they're looking into getting into savings accounts and other investment accounts. So, and Root Insurance actually as well is also looking to get into the renter's insurance area. So there's a lot of these firms are expanding their product list. So the discussion questions I have for the class are: would you consider using a service like Chime over a traditional bank? What market do you think could be next for fintech firms to disrupt? And do you think that services like Chime will eventually replace the banking industry we know today? I want to thank you all so much for listening to this presentation. I had a lot of fun putting this all together, and I hope you all learned something. Can't wait to discuss with you guys more on the topics, and have a wonderful day.